Hi, this is Jim Cunningham. I've got Christina Lindsay Orta with me here again. Today we're going to talk about crucial tax and retirement strategies for business owners. Now, Christina, the poor W-2 people of the world, they don't get a lot of these benefits, right? So the government rewards you as being a business owner. And subscribe to our YouTube channel. If you're watching this on YouTube, go ahead and click subscribe. This will pop up in your YouTube feed. We do these once a week. Next week, we're going to do very timely for this time of the year. We're coming up on Halloween, Thanksgiving. We're going to talk about the 7 estate planning strategies to guard family harmony. And Christina, we were talking before we got started. This is the Thanksgiving test. Will your family get together for Thanksgiving when you're gone? Well, let's talk about the tax and retirement strategies for business owners. So these are strategies that really are available to business owners, and it's business owners who decide this. Now, some of these do help the employees, but these are strategies that go beyond just simply a 401k. And as your business matures, as you mature, I guess, as we say, whether you operate as a sole proprietorship, LLC, S-Corp, or C-Corp, there's a lot that you can do to minimize your taxes beyond just buying equipment or whatever it is. So this is Christina. She is a partner at Ascent Wealth Management, and the Alyssa and Shannon and John are the other certified financial advisors, a certified financial professional. And this is our firm. We have a new attorney, Diego Alvarez Miranda Espeleta, and he has joined our firm here very recently. And so that is our team, and we're located throughout the state of California. I am partner at CunninghamLegal, 25 years experience. Again, we have offices throughout California, and I'm a real estate broker, certified specialist in estate planning, trust and probate law, securities and insurance license. I don't sell any real estate. Disclaimer, Christina, we're talking about a bunch of stuff. I'm a lawyer. You're a certified financial planner. This is not legal advice. This is not financial advice. Don't watch this and go out and do a bunch of stuff. So business owners, types of plans. What we're talking about is retirement planning strategies for business owners. And we've got a list of 6 here, and kind of give us a high level view of, this is one way that you can plan for retirement. What we're not going to talk about, I know we talked before we got started here a little bit about, can you invest in real estate? I don't know. Some people say, I want to invest in real estate in retirement. I can tell you my parents are in their late 70s. They have a lot of rentals. They're replacing a lot of kitchens. And because these properties are old, right? And they're okay being a landlord, but not everyone is okay being a landlord. But what we're going to talk about here is the type of strategies where you create this structure, you meet with a financial advisor like Christina, right? And they help you through that. So Christina, I'll let you take it away.
Sounds good. Thanks, Jim. Yeah, we do work with a lot of business owners. I'd say that that's where we do have a decent niche, and working with business owners and not just, large business owners, but small business owners, mid-sized business owners, sole proprietors, independent contractors, those that are 1099. Some people retire from their W-2 job and then go become a consultant. And there are other forms of retirement planning that are different and unique to the independent contractor or business owner. So one of the most common plans I think we see is the SEP IRA. And the SEP IRA is not necessarily the most beneficial. It really depends on what your income is, what your corporate structure is. Are you an independent sole proprietor? Are you an S-Corp? Are you just a 1099, realtor? So SEP is kind of what a lot of times I would say is the default that, whether it be a CPA or just an advisor, you kind of get pigeonholed into a SEP IRA. It could be a great program for you. It may or may not be. There are limitations to where you can only contribute up to 25% of your adjusted earnings. So after your write-off, so let's just say you have an income of $100,000 and you have $50,000 of expenses. Well, of the $50,000 net, you can only contribute up to 25% of that adjusted gross income. And so it might be a very limited amount of contribution. And so it's the lesser of 25% of your adjusted gross earnings, your modified adjusted gross earnings, or up to 61,000 is the max for 2022. So that's really where it takes some analysis, because maybe, you've got another spouse or another household member that has a higher income, or you don't need that whole $50,000 of income. And if that is, you would like to contribute more to some sort of a retirement plan, but you're limited to that 25% threshold, maybe we look at a solo 401k where you can just do the full maximum, 27,000, or we look at doing a simple IRA. So SEP IRA is sometimes, I would say, overutilized and oversimplified, and not always is it the best solution. Sometimes it is, sometimes it isn't.
Yeah, Christina, I met with a client this week, and the client is a 1099 real estate professional at a commercial real estate firm, and he's 52, got his house paid off, making good money, has the ability to put more away than 25% of self-employed earnings, right? And so many people reach a stage in their life where you say, wow, I'm retirement's closer. I want to save more. I don't want to be capped at 25% to a max of 61 because I'm paying a lot of taxes. And something to realize, we have two types of tax system in the United States. We have the confiscatory tax system, and I'm not attaching any political significance to this. This is the technical definition. Confiscatory means you give it to the government, you don't get anything back. That's a confiscatory system. We also have a social tax system, meaning you put something in, you get something back. The two examples of social taxes are Social Security taxes and Medicare taxes. You get that, you get a benefit back. I suppose unemployment tax would also be in there as well. But it's very important to understand as you're going through life and you say, gee, I'd like to retire. How much income do I need? And this is why you need to meet with a financial planner, right? Like someone like Christina, because she's got software, fantastic software that models this stuff out. And what you can do is say, oh, I can retire at this age. I'll take Social Security at this age. This is how much I can spend every year. And you start quantifying this the closer you get to retirement. And sometimes a SEP is a great tool, and sometimes it's not. If you need a flathead screwdriver and what you have in your hand is a Phillips, you got the wrong tool. That may be a great Phillips screwdriver, but you simply just have the wrong tool. So a SEP plan is great, can be great for the right person. It might not be enough for many other people.
Yeah,
so we have a question. Mm-hmm.
Agreed. So sometimes the SEP makes sense, sometimes it does not.
Mm-hmm.
But we did get a question. If you're a self-employed realtor and have one employee and have a SEP IRA, employee has waived participation, can I still use a SEP? That's going to be a question we'd have to look into. An employee really can't waive it. You're obligated as an employer to contribute on their behalf if they've worked 2 out of the last 5 years. So, 2 out of the last 5 years, if you do have an employee, not a 1099, assistant, but an employee, there is a requirement to contribute on their behalf. They can't waive participation.
And realtors, I will tell you, the world of realtors is every industry has its own nuances, and realtors are different than other industry professionals. Christina's mother happens to be a realtor, so I think you're probably familiar with it more than the average financial advisor. So simple. Well, wait a minute, hold on. This confuses me. You have a SEP IRA, which is the simplified employee pension plan. And then you have a simple IRA, which is the savings incentive match plan for employees. But these are terrible names. They
are. But you know what? This is it is a simple plan. It is something that it works for the solo practitioner. It also works for the small business that doesn't want to have the cost or administrative burden or fiduciary burden of running a 401k. So we've got several clients that have done simple IRAs, small dentist offices. We've had a towing company that's done a simple IRA. We've had many businesses that just, they don't have, maybe they have workers that would not necessarily participate to the full extent of a 401k. And 401ks do have administrative costs associated with them, and they don't want to incur those costs. So this is for employers that have 100 or fewer employees. And it's very simple. You match up to 3% of the compensation. So there is the other option here of doing just an automatic 2%. You can do a 2% without having to match up to 3%. So if you've got a lot of participation, everyone's going to start contributing some of their compensation. You can just say, okay, I'm doing 2% flat contribution to everybody's plan across the board. Or you just do up to 3%. So if an employee does 0% contribution, you do 0. If they do 3, you do 3. If they do 5, you do 3. And so the 3% matching contribution at the employer level is a deduction to the employer. It's a write-off to you. It also allows you to defer. It's very different from an IRA, and it's also different from a 401k. So you'll notice that these contribution limitations are very different. You know, you're limited to an IRA of 6,000 or 7,000, depending on your age. If you're doing just a traditional IRA, if you're doing a 401k, you're looking at 20,500 or 27,000, depending on your age. So this is where you can do 14,000 more than an IRA, less than a 401k, and you can do a $3,000 catch up if you're over age 50. So let's just use the example again for, I'm going to use a realtor. A 1099 sole proprietor, let's just say they have no employees and they have a net income of, I'm going to lowball it and just say 50,000. After all the write-offs, after they write off their car, their cell phone, their home office, everything else, they've got 50,000. And you're limited to 25% of that 50,000 if you do a SEP IRA. Well, is a simple better? You could probably get more if you're over 50 in a simple than you could in a SEP. So this would be where we want to say, hey, well, maybe a SEP's not the best strategy. Maybe we flip it to a simple. Maybe you want to start an employer plan. You're a new business. You don't want to have the overhead of a 401k. Maybe we start you with a simple and we ease you into a 401k. So these are things that we want to look at, is what is the best structure.
Now, Christina, for the person who's watching this, if they go, oh, I'm kind of following this, and I might be better off with the simple IRA, I might be better off with the SEP, but I don't really know. How do you learn it? I mean, obviously you're learning by watching this, but where do you go? Do you go to your CPA to set this up? Do you go to your payroll company to set it up? Where do you go?
You go to your certified financial planner, and they should be coordinating with your CPA, and the CFP that you're working with should be looking at your tax return and understanding what are the nuances here.
Good. Anita says, maybe I meant simple IRA where the employee waived. Can I still participate?
It sounds like it's a more specific question, but you know, whenever you're dealing with a qualified plan, you're dealing with the Department of Labor most of the time and ERISA. And so you have all these different rules you have to follow, and you can't just usually use the excuse of my employee waived their right. You're obligated as an employer to, if they're eligible, you're obligated.
Yeah.
It's kind of a rule of thumb.
It makes me nervous to say waiving. It's like having an employee in California who's hourly working more than 5 hours working through lunch. Oh, I'll waive that. Well, you can't do that. And as we've said before, there are many things that consenting adults can do in the state of California. And the list is very, very long. One of them does not include working through lunch if you're an hourly employee. So that's a little tongue in cheek, but it's actually true. Okay, so profit sharing or 401k plan. And what's interesting about this, let me ask you, do you have to have profits to have a profit sharing plan?
You have to have net
income.
Positive revenue. Yes.
You have to have income. Okay,
Yeah.
so but because for some startups, they don't have income, so they don't, there's an issue there, right?
Yeah, but a profit sharing plan could just be a form of a 401k plan. So as long as you have the ability to be contributing to your wages and doing some form of matching, you don't have to have significant profits to be able to do this. So again, it just is going to come down to looking at the tax return, discussing the corporate structure. Sometimes we spoke about this earlier, Jim. Sometimes you have business owners that are just ingrained in spending money on inventory or cars or equipment or trucks or things that they can take a depreciation write-off, but that has limitations too in the state of California, only being able to do that over 5 years.
Right.
So sometimes people are buying equipment and other things that they're spending money on to reduce their tax liability, where they may be better off putting a specific retirement plan together that would give them profits to work with.
I mean, someone watching this might go, wait a minute, that makes sense, because sometimes, you know, I bought the truck or I bought the equipment and they go, I paid more state income tax than I did federal income tax. Now, that doesn't happen too often, but it does happen where you can actually pay more in state income taxes than federal, because what Christina is saying is, you know, if you go out and you buy a $100,000 truck, you can deduct that 100,000 from your federal return, from your federal taxes, deduct that 100,000 in income. But for the state of California, you can only deduct $20,000 a year. So you're still going to be paying tax on that other $80,000 in that first year when you buy the big vehicle. By the way, if you ever go to like a Ford or a GMC or Chevy dealership on December 31, there's people lined up out the door buying trucks. So if you're going to buy a truck, don't wait till December 31.
Exactly.
All right. So help us unpack this 401k plan. What's, because we hear a lot about 401ks. So if you're a business owner and you have a SEP IRA, or you might have a simple, you go, I've heard of this 401k, but it sounds kind of complicated. You know, maybe you have to get a trustee. Are there legal fees? What is it expensive? And how many people are actually going to participate? Because there's a participation issue. And Christina, I don't know what the average is, but I rarely see businesses where more than 50% of the people participate in a 401k, my clients, because I think a lot of people live in paycheck to paycheck, unfortunately, and don't have the foresight to save. But anyway, just give us your thoughts on 401ks.
Yeah, so the 401k is very basic, and the IRS sets the limitations every year that what you can contribute to a 401k. So the maximum contribution limit between both employer and employee is no more than 61,000 can go in, or plus the additional 6,500 if you're over age 50, between both employee and employer. That's the max that can go in any one calendar year. Now, the employee can defer, and I'll say defers into a pre-tax 401k, meaning pre-tax, you get that deduction off of your taxes. 20,500 is the current annual limit for both employers and employees. And you can make that additional $6,500 contribution if you're over age 50. That usually gets adjusted for inflation. It comes out with new limits every year. You can also do a Roth 401k, which is an after-tax contribution. So it's not what we call a deferral, it's called a contribution. Whereas Roth IRAs have very strict limitations if you have a certain amount of household earnings of income, individual income limitations, married filing jointly income limitations. If you make too much money, you cannot contribute to a Roth IRA. That does not apply. You can have whatever income and still contribute to a Roth if your employer offers a Roth plan, and those are becoming very common. So it also is worthy of understanding, should you do a Roth contribution? Should you do a pre-tax contribution? And really looking and understanding at your tax situation, what makes the most sense? Because you may want the tax savings now, but are we also looking at this in retirement? If we defer, how much of this is snowballing to becoming a huge tax liability later? Now, there's pros and cons to both. So there's no one size fits all answer. And it may make sense in some of these other plans that we're going to talk about in a minute. Maybe it makes sense for the employer to do a Roth 401k contribution to have some money going into a tax-free bucket later, because anything that goes into a Roth comes out tax-free in retirement. Where maybe we do some in the tax-free bucket and some into a cash balance plan or profit sharing plan that we're going to talk about further in a minute. That's tax deferred because we need a huge tax write-off now. So maybe doing a combination of the two.
So what you're talking about here is this sort of balancing. And, if you put money into let's say you're 40 and you put money into a 401k, you put 10,000 in a 401k. You're not going to pay income tax on that 10,000 in the year that you put it in the 401k. That's going to grow. And let's say it grows to 50,000, but you have to take it out at age 72 or age 75, maybe, if they change the rules. But when you take that money out, that 10 that you never paid tax on has grown to 50, and you're paying tax on the full 50. Now with a Roth, the 10,000 that goes in, you're paying tax on that 10,000, right? But 10,000 goes into the Roth. And then when it grows to 50, that money comes out income tax free. And I will tell you, when you look at the long arc of history, if you will, and if you look at the arc of demographics, every smart person is saying that income taxes are going up. Okay. This is just a demographic. It's a fact of demographics. There will be fewer workers in the future. And that's going to be a big source of funding the government, is all these retirement plans. Okay. So it's something that Christina and I, when we plan for clients, we do assume, or we do presume, that we're at a low point when it comes to income taxes, and they'll only get higher as we go forward.
And then a lot of times too, just before we move on from the 401k, even if someone's doing a solo 401k, the sole proprietor or independent business owner, they may only do the deferral because they don't know that they can do the combination up to 61,000 or 67,500.
So we have a question. Is this 60,000 in place of paying income tax? No, this is a deduction. So when you put the money in, it is deducted from your taxable income. So if you put 60,000 in, you're paying 20,000 less in tax or whatever it is. Now, explain to me the 60, because I'm seeing sources of contributions. I see a $20,000 number plus 6,500, and then a $61,000 number plus 6,500. What's
so the employer match, which could be a variety of calculations. It could be nothing. It could be 6, 7, 10%, depending on what the employer wants to do. And there could be additional profit sharings. Just means that the total sources of contributions, the most the employee can put in, is up to 20,500 of their taxable income plus 6,500 if you're over 50 with the catch up. That's the most the employee can do. The employer can add additional components, but the individual social security of that particular participant cannot have an annual contribution over the $61,000 limit.
Yeah. So basically, if you have two jobs, let's say you have two full-time jobs, you're working really hard. You might get 20,500 from one employer and 20,500 from another employer, right? Is that what you're saying?
You could, but the employee can only do 20,500.
Yeah, but the overall cap is 61 plus 6,500. That's just the maximum. Now, what if you say, well, gee, putting away 61,000, it's not really going to help. I'm making $1 million a year and I'm 53 years old. Like what, how, and I paid off my mortgage. I put my kids through school. Now I need to save for retirement and I keep paying 500 grand a year in taxes. I'm gonna have to work another 5 years, right? In my 60s. I don't want to do that. How can I pay significantly less in tax if I have a lot of money to save? And maybe if we can talk about that.
Yeah, we do start then looking at profit sharing plans and maybe adding a profit sharing component with a cash balance component. So then we start really looking at that next level. Okay, we've got a really high revenue, high K1 or high taxable income situation with a business owner. And what can we do to really maximize the tax savings? And so one of those would be step one, adding a profit sharing contribution, where profit sharing is typically already written into an option of most 401k plans. So if you have a really good year, you could choose to share those profits and take a bigger deduction and share some of that with your employees. And I will note that on the profit sharing side of the equation, anything that an employee contributes to the 401k, it is 100% vested, meaning that they can retire, quit the job, leave the company, and that money is theirs to go with them forever. But a profit sharing component does have a vesting schedule. And so you can have requirements that they have to be there for 2 to 6 years, 3 years. There could be different requirements that you can use an incentive to retain those employees. It doesn't mean that you give it to them and if they leave tomorrow, they can take it with them. There are some requirements that go with it. So we can discuss what requirements you'd want to add for your particular business. But this is where you can do it either based on a strict percentage and just say, hey, everyone's going to get an additional 5% of profit, 5% of their compensation. And then distribute that to their 401k profit sharing plan. And you take that as a write-off at the corporation level. So that's step one. It's something that you can do discretionary. It's not set in stone. So if you say, hey, we've got a really good year this year, we need to mitigate taxes, but we're not really ready to take on the next step of doing a defined benefit or cash balance plan, which we'll talk about next, because that has specific ongoing requirements. Profit sharing, you could do in a good year, do nothing the next year. There's no obligation to continue to do it.
And that's a great retention strategy. And there's also, this really gets into maybe psychology. And if you're a business owner, why are you a business owner? Why do you get up and work harder than really you need to, frankly, if you're a W-2 earner, let's face it, right? More stress, more, your mind maybe never shuts off if you're a business owner. Why are you doing this? And for some people, I want to do it because I care about my employees that I work with and I want to see them succeed and I want to see them have a great life. Other people don't share that belief, but this is a great way to get more money to employees. And that serves for retention and a lot of goodwill with the employees. So let's talk about contributions, Roth versus traditional. Again, Roth,
Yeah.
you pay tax before you go in, you already get that haircut, but everything that grows after that is tax-free. With the traditional 401k, you're getting a tax break, but then as that asset grows, you're gonna have to pay taxes on the full amount. And
Yes.
it's not one or the other, right? You can have both, right?
You can have both. And so one of the things that's also important to understand is anything that an employer does that's a matching contribution, or anything that, so if an employer matches 4%, that's going to always have to be on the pre-tax component. So even if an employee says, I'm putting all my money in the Roth, but the employer matches, that has to go in the traditional because the employer is taking the tax deduction. So the IRS says that has to, go into the pre-tax bucket. So, but you could say, hey, we've got several clients where we've advised them do, half of your contribution in the 401k traditional, take the tax deduction, and do half in the post-tax bucket. Roths have no required minimum distribution at age 72. So they will grow tax-free. They will come out tax-free without any requirements from the IRS. They get inherited tax-free. But again,
free of income tax, not a death tax, but
correct. Yes.
Free of income tax.
Yes.
And it's interesting because I think, this gets into people's attitude. What is this money for and who is it for?
Mm-hmm.
You may be working and you may say, I know when I pass away, I'm going to have an estate. So when you do, and you might be in your 50s, and if you're doing a Roth 401k, you may never access that money in retirement. You may never access it in retirement. Yeah. And so really it's a shift in mindset. It's like, well, even though I'm putting this money in my Roth and I'm 53, my kid's 23, you may want to think about investing that Roth money in an investment that's suitable for a 23-year-old, not necessarily a 53-year-old. So again, there are a lot of layers on the onion when we talk about this. And this is why you need a certified financial planner, somebody like Christina, to help you go through this, because I would say there's a heavy amount of counseling on this, and it doesn't get woo-woo psychology, but it might. But there's a heavy dose of psychology, which is, what do you want out of this wealth that you've created? Because when we leave this earth, we leave our bodies behind. We leave everything behind when we leave this earth. And so thinking about the legacy that you leave, believe it or not, is part of this retirement planning, because this money's going to go somewhere, right? So,
yeah.
All right.
And what your tax situation looks like is really critical.
Cash balance plan. I love these. These are great.
These are great. We're doing a lot of them again. And this is one of the reasons why we have this webinar at this time of year, is because if we're going to do this, we need to do tax planning. A lot of people have just passed the October 17th tax deadline. Business owners typically file an extension. So they filed probably September 15th for their business and October 17th for their extension. So they're just getting past their 2021 tax liabilities and going, what do I do for 2022 to make sure I'm not paying as much taxes? There's one thing we can implement before year end, which can make a significant dent for business owners for their tax planning. It's something we have to implement before the end of the year. So that's why we tell people, if we're going to do this, we really want to know by the first week of December. Otherwise, it's going to get real difficult to see if we can get it done by the end of the year. And there's a lot of different functionality that goes into a cash balance plan. We have to engage an actuary. We have to get the census. We have to know what payroll to issue the W-2 for the business owners. And so if they're taking a salary, if they're flowing it through on a Schedule C, or if we need to do a payroll and have a year-end distribution done, there's a lot of things that have to be done before year end. That being said, this is something that can help you on your 2022 tax planning, but is not obligated to be funded until September 15th of next year. So it's something that if you're going to have a very large, significant tax liability and have the predictability of consistent revenue going forward, because cash balance plans do have a caveat that you can't just do this one year and stop at the next year. Otherwise, the IRS sees it as a tax loophole. And it's something you have to have reasonable predictability of funding 3 out of the next 5 years. You can pause it if we have a really, unforeseen circumstance. You can pause the plan, but it is something that we need to see realistic continued contributions. This can move the needle in a significant way because there are defined benefit. So I'm going to take a step back for a second. There's 2 types of plans. There's defined contribution plans, which the IRS says, okay, on a 401k or a simple IRA, we're defining the maximum you can contribute. You can only contribute up to X. On a defined benefit plan, that is age weighted. It is something that you can have a little bit more option to skew towards the benefit of the business owners. You cannot discriminate in any way, shape, or form on a 401k ERISA plan. On a pension plan, it is very owner-driven benefits with additional benefits still to the employees that wouldn't otherwise be there. So it is still a huge benefit to employees. That being said, it's something that is more oriented towards the business owner and older employees. So if you have a lot of older employees and highly compensated employees, it may not be the plan for you as a business owner. But it's defining a future benefit at age 65. So think of pension plans. A lot of times, teachers, government workers, you work up until age 60 or 65, and then you have a set pot of money that's going to pay you an annual benefit as a pension for the rest of your life. That is a cash balance plan as a form of your own pension plan. And so the closer you are to attaining age 60 or 65, there's a specific set IRS limit that you can have in the form of a pension that will give you a benefit the rest of your life. So the older you are and closer to that age, the more money you can put in to fund that pension plan.
So we have a question. If somebody has established IRAs in a particular plan, can they change to something less taxable?
Depends.
That's a lawyer's answer.
It depends. It depends on what you have. Can we convert? Can we not convert? Is there a tax implication? What's your corporate structure? Is there ERISA rules? Are there Department of Labor rules? Are there certain testing liabilities? So it really does depend on the type of plan. Are there employees involved? What's your age? What are the limitations of the plan documents?
Let's talk about these people here, because I talk to a lot of these people, and there's something magical when you turn 50. You start seeing the end of the runway. And what I mean by that is you start realizing, wow, how much longer do I want to work? My kids are kind of getting through college or starting, or you're working on that. And then you start thinking, how am I going to fund retirement? How am I going to catch up? Perhaps, how can I pay less tax? And this is really I'm really glad you put this here. Let me just, this thing here, these are your tax deferrals. What this means is you're paying this much less in tax. And if you think about it, you can put the money in a bank account, right? And you can just save it after tax money. But if you do this for 5 years, you're going to have $500,000 more, $600,000 more. That may mean you could retire 2 or 3 years earlier. And I will tell you something, talk to people who have self-identified as working too long. And a lot of people I talk to, they say, Jim, I wish I would have retired sooner, because, you get older, you just don't have the energy. I want to travel, you want to do whatever it is. But again, this is part of embracing the aging process, if you will. And looking at it and thinking to yourself, well, how much longer do I want to do this business? What other things do I want to do with my life? Do I want to go to Italy? Do I want to go to Tuscany and learn Italian and have great food and drink great wine? Have a plan, right? And tell your certified financial planner, right? Tell your planner, this is what I want to do, and work it into a budget. So it's good stuff.
Yeah. And before we move on we had a quick question that just said, this slide only illustrates up to age 65. Can you do a defined benefit plan or a cash balance plan after age 65? Yes, we've done them for older ages. When you hit the age 72, we start hitting that you still have a requirement to take some out. So we have to analyze the cost benefit analysis, but you can still put some money into a plan over the age of 65. And this is just an illustration of just showing what could be put in where, you're limited again to that $61,000 limit on a 401k. We might be able to get 280. We might be able to get more. Yeah. So this is just for illustrative purposes, and assuming you're in a 50% tax bracket, that's tax savings in the green side there.
Let me ask you a question that no one's asked. On this cash balance pension plan, can it be a Roth or not?
No.
Okay. Thank you.
That is something that we're taking the tax deduction on now. and eventually will come out taxable.
So
But
there's no there's no way you can do a cash balance pension plan and have it be classified as a Roth and not take the deduction, but have the future growth not be taxable. Okay.
correct. And because there's an element of contributing on behalf of employees. And so anytime that you're contributing on behalf of employees, it has to be done on a pre-tax basis. The corporation and business owner gets a deduction and the employee gets some sort of a benefit in a pre-tax form that will be deferred for their benefit. So because of the nature of it, it is designed to be a tax reduction strategy for business owners as well as a retirement plan.
All right. What are we looking at here?
Yeah, this is a case study of just a business owner. And this is just showing their census. So this is probably, your typical small business and, less than 25 employees and husband and wife, joint business owners over the age of 50. So they're, you've got owner, and you see those other categories of 18, 21, and 24 because their 3 kids are classified in the owner group for testing purposes. And so there's just different rules when it comes to a cash balance plan where you can discriminate against your own family. And so you can put them on payroll. They can have all the perks and benefits of contributing to a 401k, but we want to maybe have most of the benefit really go towards the business owners, the real business owners, the mom and dad that are running the business. And so this is really where we say, hey, we want to do this planned compensation. This is a coordination of efforts with your CPA and saying, okay, what's appropriate for the compensation? And in this case, we said, okay, $305,000 is the right W-2 for one of the owners, and the other owner really only needs to have a $30,000 salary, just enough to do the $27,000 401k deferral limit. But it's not going to move the needle to increase their compensation or make them pay more FICA taxes just to have a higher wage. So this is, we kind of back into these numbers. We massage this a lot. There's a lot of planning involved. And this is really where we can say, hey, with this scenario, you can see this is a very diverse group of people. And this is really where we're going to look at the factors that weigh into the testing of this. But this is really where, in this case, we see the owner there at the bottom is able to put $200,000 into a cash balance plan. And if we see the total, that 220, so the employer is writing off of their corporate revenues and getting a deduction to what's taxable as income to the corporation of 220,000. And of that 220,000, hey, employees are getting a good $20,000 of additional benefit they wouldn't have otherwise had. And it has vesting requirements. They have to stay with your company in order to receive those benefits. It's typically a 3-year requirement from the time we implement the plan. And of that 220,000 that's giving you a deduction as the business owner, 200,000 of that is going directly towards your own retirement plan. So this is really where we can start adding bells and whistles and getting more money than what those typical limitations are on a 401k.
And looking at this again, putting it into context, somebody may say, well, I don't want to give my employees another $20,000. But I really think what you need to do is not focus on where the money's going in the buckets, but again, meeting with your certified financial planner, your CPA, to a lesser extent, your lawyer, because this is really kind of CPA, certified financial planner space. But what is your goal? If your goal is to retire at age 62 and travel for 5 years, how do you get there, right? Because these are just tools. And if you say, look, I'm going to work until I'm 90, well, you may not even need to do this, right? And if you don't care about paying taxes and you're going to work till you're 90, maybe this isn't for you. But if you're the kind of person who says, hey, I want to do this in my life, I want to do this while I'm still young enough and healthy enough and able enough, then that's really good. I mean, Christine, I love it when a client comes in and they say to us, isn't it great when a client comes in, they say, I want to retire as soon as I can and do these things in retirement. And this is kind of the budget I've thought about. I mean, you and I, when those clients come in, it's fantastic because we're really able to help them and we're able to use the appropriate tools. But this is a fantastic tool because the alternative is if you don't do this, you get another 200,000 in income, you're paying another 100,000 in income tax, right?
You can either pay your employees and yourself, or you can pay Uncle Sam and Gavin Newsom. So you can choose to where you want to put the benefits. If you have the revenue and you've got a tax problem, there are sometimes better solutions. And what we also see is in the profit sharing contribution level here, of the 86,000 we're doing towards profit sharing, you'll see only 40, 2,000 is going to the benefit of the owners, because we have to do a little bit more profit sharing with employees, but that's over a 6-year vesting schedule, whereas the cash balance is over a 3-year. So it's a little bit of that golden handcuffs, if you will, but it's a huge employee perk. And we do a little bit more on the profit sharing side to keep the cash balance side really benefiting the owners. And so this is, again, that we massage the numbers to see that it still meets the IRS requirements. And we work with an actuary, we work with your CPA, and we kind of work to figure out what's going to be the most and what's the business owner willing to contribute. Because if they tell me, hey, okay, this shows my total contributions here is 337, I really only have 250. Okay, well then let's start working backwards. And if we're going to work with a 250 contribution, and we still need to get some tax benefit from that, what does that look like? And so this is just hypothetical, but you can see it moves the needle on providing a corporate tax savings. The corporation is getting a tax savings on 337,000. If we go to the next slide, this is kind of the summary, and it shows that we're saving them $176,000 in taxes if they're living in the state of California.
I mean, I'd rather give it to my employees than the government.
If you have it to give, or you're paying the taxes.
Yeah.
And this is just really where, again, this has to be something that we are expected to continue for 3 out of the next 5 years. So if you're a business that's kind of like all over the place with revenues, this is probably not something we're going to say we want to, sign up for right now because it's too uncertain. Maybe we just do profit sharing. So this is definitely going to be the right client where you've got some predictability in revenues. But when we do, this is a plan that really moves the needle.
We see this a lot with physicians and dentists who have a physicality to their practice. And I had a plastic surgeon client years ago. He said, plastic surgeons can only practice for about 20 years because they stand all day and they're doing this and they're, kind of in these weird body positions, and you're just tired. And the same with dentists, you got your hands. That's why dentists work 4 days a week typically, is because they need 3 days to rest their hands, because it's a very physical, there's a physicality to it. Sure. So if you're a dentist or you're a plastic surgeon or you're a physician that has a physicality to your practice, look at this, right? Or if you're someone who has consistent income and that you want to pay less tax and do something else other than what you're doing, maybe in your 60s or 70s, take a look at this. So this is really
absolutely
good stuff. And I'll tell you what, Christina, I talk to lawyers. Lawyers don't know any of this stuff. I would say a lot of the stock jockeys out there, people who are working at wirehouses, do they know this stuff or not? I mean, if you go to and we won't name names, but a wirehouse are like the big companies you see advertising on TV. Do they have this or not?
Can they do it? Yes. I would say that the overwhelming majority of a Wells Fargo, Edward Jones, Vanguard, Schwab advisor, if they're not, most of them are stockbrokers or investment managers where they're just picking investments. They're not doing real financial planning. Can they open an account that's titled as a defined benefit plan? Sure. Do they really understand the inner workings of it? Most of the time, no.
Yeah. And there's a lot of effort. There's a lot of time, effort, attention, and detail that goes into this that I will tell you, I know Christina really well. She loves this stuff. This is really stuff that she gets up, and if she's like, I got a cash balance pension plan thing to talk about today, she's fired up to talk about that. Not everyone who's really focused on investments, strictly just, what stock should you pick today, is necessarily going to have this in their headspace. So it's a little bit of a nuance in the practices, but Christine is very good at what she does, and we highly recommend it from our clients. So we get a lot of good.
Thank you. And my team's great at it too. We focus on comprehensive planning, and we're definitely not one size fits all. Everything is very custom. There has to be coordination. One of the things that we enjoy is putting that puzzle together. And part of doing a 401k plan is a puzzle, because there's all different sorts of things involved. investment selection. What investment choices are you offering to your employees? Are those the best choices? Okay, well, what if this bond fund all of a sudden has a red flag within the SEC and you still have it on your platform? Your employees can sue you. You know, if you're the trustee of the plan and you're the fiduciary that's overseeing that plan, you're the employer offering this plan to your employees, and all of a sudden this Vanguard fund blows up, and your employees are going, well, why do I have this as one of my options? So there's some fiduciary liability to make sure that you're offering the best in class funds that have low cost, that are truly seen as the best. If you need to offer a real estate fund in your platform, is this fund the best, or is it a Fidelity fund, or should we use a Vanguard fund? Or those types of things are things that need to be analyzed, and you don't want to be liable. So we typically encourage people to engage a 338 fiduciary, where you're paying a little bit of a negligible fee to have that responsibility and liability taken off of your plate.
Yeah, let me translate what you just said. When you are a business owner, you are focused on your business. And what we're talking about, you might be looking at this going, this sounds really good, but oh my gosh, this sounds so complicated. I know someone's going to hand me a stack of documents and I'm going to sign them, and I trust the person I'm working with. I mean, or you might be the person who's like, I'm going to read everything, which is fine, but you might be the kind of person who's like, okay, well, you're the expert. I'm going to sign it. Here you go. Something that's very, very important to understand that I think people do not even think about. What Christine is talking about with a fiduciary, there is a trustee on, for example, on a 401k plan, there is a trustee. That trustee has fiduciary liability, meaning they have unlimited liability. You better know what you're doing if you're a fiduciary. Too often, the business owners are the fiduciaries. Now, if you're a business owner, I can pretty much, without even knowing you, probably guess that you don't know much about this stuff at all. You don't know much about investments at all. It is not worth the risk, because people do get sued on this. Does it happen frequently? No, but the numbers, there's a lot of zeros in there, right? So it makes sense to go with someone who knows what they're doing, like a Christina, who can connect you with, and it's not Christina who's a fiduciary. These are professionals whose job it is to pay attention to the underlying investments and go, hey, this one was flagged by whatever reporting agency, but if no one's minding the store, you don't know that something's been reported. And that's why it makes sense to hire a fiduciary, because they're kind of like the cop, if you will, on the plan.
And
Right?
you'll see, like, you'll hear about different major corporations where they're getting a lawsuit against them for their 401k and the lack of options they had, or what have you, and just making sure that you've got some sort of system and process in place. And what I will say is that most payroll companies do not do this. And the one thing I'll also highlight real quickly here, because this, if we go back just a quick second, there's a little part of the puzzle that says control and affiliated service groups right over that green one. And we're having a call tomorrow with a client that we're looking at putting in place a defined benefit plan or cash balance plan for. And one of the questions that also we have to look at is sometimes business owners have multiple entities. Maybe they derive their income over here, but they also own another company over here. This company has no employees, but this company does have employees. What are their obligations? What we have to make sure we're not doing is violating any rules by saying, hey, we're not doing any participation or funding for these employees because we're only going to do a plan on this entity. Is that going to be a problem? Is it going to be something that's scrutinized? Are we hitting those thresholds where we're just a minority business owner, so it doesn't matter that there's employees over here? Those are questions we have to make sure that we're also abiding by the rules, and those get overlooked if you don't have a team working with you on that.
Great point, Christina. Believe me, I'm aware of those rules, and they even trip me up. Okay. Just honestly, because you go, oh, well, there's that rule. I forgot about that. And this is why it does take a team, right? I'm not perfect. You're not perfect. We all got to work together on this. Okay. Payroll provider. What is a payroll provider? What is that?
Yeah, a lot of times people use ADP, 401k, paychecks. Nothing wrong with those. They do their payroll. They do a good job with payroll. A lot of times they bundle the extra services of, let us do your 401k, let us do this. Most of the times they will only do, and I'd say 99.9% of the time, they will only do profit sharing. So if you said, hey, I've got a huge calendar year, extra revenue, big settlement we had this year, we want to pay our employees an extra 5% of their compensation through profit sharing, that they can do. But as far as record keeping on doing a cash balance plan, adding that as a component of the plan, they cannot do. So they're also not fiduciaries. So they're not limiting you from that liability, typically as a 338, to make sure that you're protected as an employer, as a trustee of the plan.
I mean, it's kind of like going online to do a living trust, right? To do your estate plan. To go out with an online provider who's not a lawyer. They're not a lawyer. There's no fiduciary relationship. They owe you no duty. It's like, okay, we'll help you write up a document, and there's no help. It's like you call 1-800-NO-HELP for help. And there's no help.
And we had a question, it says, if I have a payroll company, who do I coordinate with to remain compliant? If you're just doing a basic 401k and you're not doing profit sharing, cash balance plan, and that's just what works for you, and your payroll provider is probably sufficient. But if you have a lot of employees and they're not acting as a 338, specifically a 338 fiduciary, you probably want to remove the 401k plan and separate that from your payroll provider.
All right. Life insurance.
Yeah. While we're talking about business owners and just other forms of retirement plan, again, maybe you're a business owner and you have a lot of employees and it just doesn't pencil to do a cash balance plan because the costs are too high, or you don't get as high of a percentage of the benefit. And you just go, if I'm getting 80% of the benefit, yeah, that makes sense. If I'm getting 50% of the benefit, maybe it's not as beneficial. So then we start looking at other options, and we can say, well, maybe we look at doing overfunding of an indexed universal life insurance. Now, I would say that I have a huge caveat to this, because there are life insurance brokers that are not fiduciaries, that are not financial planners, that are not CFPs, that are only insurance licensed and oversell this solution. So here's my huge disclaimer caveat. This is not a solution that is always the best for every person. And so, but this is an option, and we can look at good options where you don't have caps of annual funding. It is something that we typically want to fund over the course of a minimum of 5 years. You can't just do a lump sum and be done. Otherwise, it changes the tax implications. So it's something that we want to do funding over the course of a minimum of 5 years. It could be something we fund over the course of 20 years, 10 years, 12 years. But it's something that doesn't have annual limitations. So if we're looking to really fill a bridge a retirement gap where you're limited on the 401k and you still want to do extra tax savings, maybe you don't have access to a Roth 401k, anything that goes into an indexed universal life policy will have a death benefit that will provide you maybe a really good death benefit while you're still working to be an income replacement to your family. But then when you're in retirement, we can take withdrawals against that cash value and have tax advantages to that. So just another option for business owners to look at. Maybe we do need good death benefit coverage, because if you're the breadwinner and your income went away, we need to plan for death benefit. But how do we do so in a way that you're not going to need this death benefit forever? Is there a way you can recapture benefit back when you're in retirement?
Yeah. And again, Christina, I would put this in the class of tools. And I think some tools are oversold, frankly.
Yeah,
and
exactly.
This can be an appropriate tool. And let me give an example. Somebody who is maybe in their 50s or 60s, and they're working and they're making a lot of money, they may want to use this type of an insurance product, because if that person dies, they may have a family to support. They may have a spouse to support. So remember, there's a death benefit component to life insurance that kind of juices up the dollar amounts that are available. If the insured passes away, so can be very important. Again, to your point, too often oversold. Anita asks, is this hypothetical? If someone is 85, still fully employed, and I know that's you, that's okay. Variable income now, is late to have a portfolio check for advantages, plan to just enjoy free time at retirement and retire within 1 year. Any retirement strategies there? I don't think she can do a cash balance if she's going to retire in a year, right?
Probably not. No.
Yeah.
So just really kind of just takes an overall holistic analysis of the entire situation and just see if there's anything that we can do.
And can you withdraw from an annuity as an RMD without dying? I mean, I think so. Yes.
Depends on the type of annuity.
All right. All right. So what we're talking about here is the coordinated 3-legged stool, which is your estate planning attorney, your certified financial planner, and your CPA or tax advisor, because there are some EAs who are very capable and competent and may be appropriate for you. CPA is a different designation. And this is how you reach out to us. So you can contact Ascent Wealth Management at 805-312-7200. And there is Christina, Alyssa, and Shannon who are available to meet with you. And they're each one of them fantastic. And here are our phone numbers to reach out to us, to reach us by phone, and our website. Our toll-free number is 866-988-3956. When you call our firm, two things are going to happen. You're going to call and make an appointment, and you will likely end up paying a little bit of money for a consult fee, which they can talk to you about on the phone. But that's all that's going to happen. So if you want to call and talk about your situation, the people that answer the phone are not lawyers. So don't hit them up for information or advice, because they're not qualified to give legal advice. They're not qualified to quote fees, but they can talk to you about the process of how you get to a lawyer. And that's something you can reach us by phone. You can also go to our website and ask for a time to meet with us. And we have our offices here in the Bay Area and Capital Region, as well as Southern California. If you're watching this on YouTube, please subscribe to our YouTube channel. And if you are one of our clients or like what we're doing, please review us on Google. On Google My Business. You can just Google Cunningham Legal and it pulls up your closest location. And again, we do have the Thanksgiving test coming up, right? This top 7 estate planning strategies to guard family harmony. Christina, do families ever end up not harmonious? Is there ever discord in a family?
That's an easy one for me. I think Jim and I first met the day I turned 18. My uncle decided to sue me for my college funds. So families are not always harmonious, and when it comes to money and money's involved, and you want to make sure that your wishes of what you want done with that money and your estate plan are lockstep with how your documents are drafted and if they're outdated. But yeah, and we do, based on the multiple offices Jim shared, we also have offices in all those locations, and we will be happy to do an initial consultation. We always do a complimentary initial consultation, and then we will advise if there's things that we think we can be of assistance with, and discuss fees, and go from there.
And thanks to you. I love what you share with us always. Thank you. Well, thank you for watching, and stay tuned, because if you're watching this on YouTube, there's another video coming right now. So just keep watching.